Hello people, this is class exercise number 9. In this practice, we're going to study Fama-French three-factor model and learn how to use that model to predict the performance of a portfolio. So last time we learned about the CAPM model, and the CAPM is about how to use the market return to predict the stock return. In fact, under the theory of Dr. Steve Ross, he developed this arbitrage pricing theory, and the framework is telling us that all the returns can be explained by a number of factors. So this F stands for the factors, and this alpha, okay, this is not a letter A, we call it alpha, is the abnormal return for the for the performance. So that's the basic multi-factor model we're going to learn. And if you look at the predictive model in the macroeconomic sense, so you will see that the stock return can be explained by the market return. They use the NYSE to represent the market return, and they also use multiple factors like inflation, like the industrial growth and the bond market indicators and so on. Okay, but that's not the point of today's exercise. So today we are going to learn this model. It is called a Fama-French three-factor model, and this is developed by Dr. Eugene Fama from University of Chicago and Dr. Kenneth French from University of Dartmouth. And this model was widely cited by the academics and also widely used by practitioners in fund management. And this model helped Dr. Fama won the Nobel Economic Prize in the year of 2013. Under this model, you will see that the performance of a portfolio, okay, the R is the return for the portfolio. I stands for the individual portfolio instead of just one single stock, and that's pretty important for you guys to know. So when we're using this model, we use to predict the performance of a fund, a portfolio with a group of stocks instead of just a single stock. And right here you got this risk premium. Once you use the return minus the risk-free rate, then we call that risk premium. Okay, that's the Y value to be predicted by the model in the regression analysis. And the X values, okay, so I use plural because there are multiple X values. So you will see this market return minus risk-free rate. Does that feel familiar to you? Yes, it does. That's the CAPM. So if we just take a look at this part so far, that's the CAPM model. But Dr. Fama developed the model, and he added two other factors to predict the performance of the fund. So the factors are size factor and value factor. S and B stands for small minus big, and HML stands for high minus low. It is easier to understand small minus big because the small stocks are those with lower market capitalization, which is the stock price times the number of shares. Okay, so small stocks performance in this market, you put them in one portfolio, and in another portfolio you put all the big stocks in the market, and then you use the small stock returns minus the big stock returns to get this factor. And the other factor is called high minus low, and that is about the book to market ratio. In the fundamental finance class, you learned that ratio. So the book value comes from the balance sheet, that's the total equity, the common equity for the firm, and the market value is the price times number of shares. So the market value is the market capitalization in the SM factor. That's that is the size in the sense of market. But there's also another way to measure the size of the firm, which is the book value, and that is about how many assets the firm have. Okay, and the if the firm has a high market book-to-market ratio, then we call them value stocks. If the firm has a low market-to-book ratio, we call them growth stocks. Okay, and there's also risk to be considered. So if you look at the entire history of U.S. market, the small stocks have higher risk than the bigger stocks. Therefore, the small stocks should outperform the big stocks in the long run. But it doesn't mean every time. And of course, sometimes big stocks outperform, but small stocks perform better more in more times. And also for the value stocks, the one with a high market-to-book ratio, they outperform the low book-to-market ratio stocks. So the value stock outperform the growth stocks. It's all because the value stocks are riskier than the growth stocks. So if a firm has high book-to-market ratio, then that means the book value is high. The firm has a lot of cash, a lot of assets on the book. When the market value is low, that means the stock is the firm is not making profit, so it's not favored by the stock buyers. So the market value for the firm is low. Okay, so that explains the high book-to-market ratio. So these kind of firms are riskier than their counterparts. And Tesla, Apple are those with a low book-to-market ratio. So that means their market value is high compared to the book value. So that's what low book-to-market ratio means. Okay, so after explaining that, I have downloaded the data from a Pharma French website, and you can see these three factors. That's the first one in column B is the market risk premium. That's a market return minus risk-free rate. The second one is small stock returns minus big stock returns. The third one is the high book-to-market ratio stocks returns minus low book-to-market ratio stock returns. Okay, high minus low. Or you can treat that as value stock returns minus growth stock returns. And then you also need a risk-free rate to calculate the risk premium for the fund, for the portfolio. The portfolio we're analyzing is actually we have two mutual funds. So the first one coded UMPX, and the second one is PVIVX. So the names are pretty weird. These are the code name of the mutual funds. So if you just copy paste and then do a Google search or do on Yahoo Finance, so you will see that this is a profile for UMPSX. And that's the performance today. And the profile here is telling you it is management by this company. And Devin Sullivan is the portfolio manager. And also the feature of this mutual fund is that it manages the small stocks. You see in this row it's for small stocks, and in this column that's not either value stock or growth stock. It's more like a blend of both. Okay. So that's the investment style. This website also tells you about the other features, like the fees, the 12B1 fees and front load fees, and the operating expenses, net assets, and so on. All right, and you can find the same information for the other mutual fund. So each mutual fund is a portfolio because they include more than one stocks or maybe sometimes bonds, so they can cover a lot of securities in their management. All right, and let's see whether they perform good or bad. So we're going to conduct a Pharma French three-factor model analysis. And what you're going to do is fairly simple. You just run regression for each mutual fund. And the thing is you need to get the risk premium first. Okay, I use RP to stand for risk premium. And for the first one, I will use its return minus the risk-free rate. Okay, nice and easy. And for the second one, the risk premium of PVIVX, I will use its return minus the risk-free rate. Okay, so this one is too long, so I will decrease this decimal. Okay, and then I just drag it all the way down. Okay, so you can see the risk premium is produced, and that's just what I did here. Okay, following the rule. So I used the return minus risk-free rate, and then I got all the three factors lined up. So you see that these are my data area, and I will conduct regression analysis 2 times. So I will do for the first mutual fund regression. Okay, the Y values would be the risk premium of this mutual fund. And for the other two, let me just write them down. So for alpha, it is not different from 0. So there is no abnormal performance. So basically, everything is expected. So if the firm has good returns, that basically means they invest in high beta stocks, small stocks, and value stocks. So right here, so beta equals to 2. So that means the stocks, the fund focuses on high beta stocks. Okay. And the high beta stocks basically means when the market is doing good, then this stocks will do twice as good. Also, when the market is doing bad, then this stocks will do as twice bad. So that's basically how you put down explanation here. Okay, and you're gonna do the same analysis for the other mutual fund, and then you're gonna do the same explanation as what I did here. So you're gonna look at the p-value, and you're gonna highlight the coefficients, and you also need to write down the description here. Okay, based on what you see from the regression result on this mutual fund. For the X values, you're gonna select all 3 factors. That's right. So instead of just 1 column, you're going to select the 3 columns of data. Okay, Control-Shift down arrow, all get selected. All right, and then you hit OK to have the result. All right, so what you're going to rate here from the table is R square. Previously in the CAPM analysis, your R square was 26%, but right now it's reaching 95%, and that's super duper high. No wonder this model won the Nobel Economic Prize. Okay, so why the R square is getting so high? Why the model is so having so much goodness of fit? That means all the X variables explain the Y variable so perfectly. Okay, it's because you add just more than one. You have more than one variable here. So the first one is a market factor. That's the market return minus the risk-free rate. The second one is a small minus big. Okay, SMB, and the last one is high minus low. Or you can use it as you can write it as value stocks returns minus the growth stock returns. Okay. So in this analysis, you will see that the intercept is the alpha, and that is very, very close to 0. Okay, that's very close to 0, and that basically means this fund has no abnormal return. And you also need to look at the p-value here. So if I convert them to percentage, and you will see that this market factor has 0% p-value, and its beta is 2. So that means when the market moves by 1%, this mutual fund will move by 2% from this dimension. And the other two dimensions are size and value and book to market ratio. So you will need to judge whether they are positive or negative, and that's pretty easy to do. And their p-values are also quite small. That's definitely less than 5%. And that basically means both factors have a very significant power predicting the portfolio performance. And this one is a positive, and this one is positive as well. Okay, 1.04 and 0.68. So what does that mean? So the implication is this mutual fund has a positive relationship with small stocks, and when the small stocks outperform the big stocks, when this factor is positive, so that means if you look at the data here, so when this small minus big, when the small stock is positive, okay, when small minus big is positive, so that means the small stocks outperform the big stocks, so these are all positive returns, then your portfolio is likely to have 1% return over there. So they are in the same direction. So that means this one is a positive. So that means the fund focus on small stocks. Okay, and this factor also is a positive. So that means when the value stock outperform the growth stocks, when that factor is positive, then this fund also has a positive return. So that means this fund focuses on value stocks. Alright, so this is how you explain the regression result based on the Fama-French three-factor model analysis. And for the other two, let me just write them down. So for alpha, it is not different from 0. So there is no abnormal performance. So basically, everything is expected. So if the firm has good returns, that basically means they invest in high beta stocks, small stocks, and value stocks. So right here, so beta equals to 2. So that means the stocks, the fund focuses on high beta stocks. Okay. And the high beta stocks basically means when the market is doing good, then this stocks will do twice as good. Also, when the market is doing bad, then this stocks will do as twice bad. So that's basically how you put down explanation here. Okay, and you're gonna do the same analysis for the other mutual fund, and then you're gonna do the same explanation as what I did here. So you're gonna look at the p-value, and you're gonna highlight the coefficients, and you also need to write down the description here. Okay, based on what you see from the regression result on this mutual fund.